So, guys, real estate is one of the most tax advantaged asset classes in the world. But the problem is, most investors don't know how to take full advantage of it. When you understand how things like depreciation, cost segregation, and 1031 exchanges work, you start to see how multifamily investing can build wealth much faster and more efficiently than almost any other investment strategy out there. Today, John and I, we're going to be walking through the key tax benefits available to US investors and Canadian investors as well, and how smart investors are using them to reduce taxes and grow their portfolios faster. John, it's great to be here with you.
So good to be here, Mark. I will say, as a lot of our listeners know, you're Canadian. A lot of our investors are Canadian. The U.S. does have a little bit of an advantage here with some of what's offered, right? I
A
think
little
that
bit?
just
Come
just
on,
a,
John.
just a tad,
A lot, a lot.
just a little bit. So a lot of what we'll be talking about will be a benefit to those U.S. investors, but we'll also cover the Canadian side of the border as well. For me, Mark, when there's times of uncertainty, hard assets are really where you should be placing your capital. And I think apartment buildings are one of the best asset classes. We've talked about it 100 times probably on the podcast, right? But, the demand for shelter and housing will never go away. And I think it's really interesting when you go onto the Fed website, you could just Google search, Fed rental rates, United States, and you go right to the Fed website. And it's amazing. They show rents from 1930s through today. And the only time they've ever dipped was during the Great Depression. They only flattened out for about a year during the Great Recession. So when you combine that with some of the tax benefits you get, it really makes it a clear choice for savvy investors looking to diversify their risk and also, get out of the public markets and get into a more stable asset class.
Yeah, 100%. And if you are looking for real estate to invest in, you can't find any good deals, and you're just too busy to be able to do it all on your own, go to fulloutinvesting.com and you're going to see our 10-step full out investing process. There's a sample deal there as well. And you can book a one-on-one with John or myself and find out a little bit more if this is the right fit for you. So, John, moving forward here, it's an interesting thing to think about that the government actually in the past did try to get into real estate, and they realized they weren't a very good operator. And so they realized that they actually need people like us to go out and buy properties. And the reason why real estate is such a beautiful thing in the government's eyes is that you look after it, but you pay a little bit from every single asset that you own to the government. It's like
Mm,
passive income for them. So that's what taxes are. And so they like it when there's a new development because they're going to get a whole bunch of taxes coming in.
that's
And
right.
so why they will say incentivize investors to be able to get into it with these tax breaks that we're going to be talking about today is because they want to say to you and I and all the other investors out there, come on in, invest into real estate over stocks and all these other potential investments. And so these tax incentives have been used for years, and they really take a asset and investment that is phenomenal on its own, and it just takes it to a whole other level where you can actually bring your taxes down to zero. And especially more so in the United States, and we'll get into the differences between Canada and the US, but when you have the government incentivizing and saying, hey, listen, go for it, that's probably an area that you want to at least look at twice.
Yeah. And it's really interesting because you said it, the government has tried in the past. And even today, a lot of what you would call like public housing. In fact, I was talking to an operator recently, a guy named Sam Sells, and he put together a fund and they are actually acquiring large chunks of that housing from local governments. Because they just don't want to be in the business anymore.
Yeah.
And so incredible tax incentives to your point. But, what we do is difficult, right? It's hard to manage the property and make sure it's up to date and, livable and, providing adequate housing opportunities. And so I'm just a big fan. I love real estate in general, Mark. I know, we both started in residential and just looking at houses. It's just fun, but there's a lot of challenges. And I think, the government recognized that it's too big of a bite for them. What I see for the government, and this it applies in any country, is the government should exist to solve problems that the public market can't, right? Or doesn't want to, right? Because certain things just aren't profitable. And so there's no profit incentive. And so housing is an area where it's right for them not to be heavily involved in terms of management, more so in just providing an easy pathway for investors. And so they've done that in the US very strongly. And I think Canada, we'll see with the elections coming up. But I think, the conservative government up there, that prime minister has made some interesting proposals. So we'll see how things shake out for Canada. But I'm keeping my fingers crossed. Maybe some of these incentives start coming to the Canadian side of the border as well. We'll see. Time will tell.
Yeah. Well, we'll see. I mean, I think at the end of the day, there are still some tax incentives as
That's
well.
right.
There's still some depreciation which you can take advantage of in Canada. But with this new election coming up, there we'll see, because there's on the conservative side, you have a proposed 1 year, we'll say, capital gains hold. So for basically, it's like a 1031 exchange, which we're going to be talking about on the American side. The conservative government that's running for prime minister and for office right now, they're saying, listen, we're going to come July, we're going to say for 1 year you can roll over any capital gains from any sale for 1 year into a larger asset, which is like a 1031 exchange. And so
Hmm.
that's not being offered on the liberal side. And so that's one big one that's actually come down the pipe recently, is what has been announced. But
Yeah.
John, I think by the time we air this, the election will have already happened, and we'll see what has unfolded there. But
Yeah.
if anything, I think with the election, is just once it happens, is going to give a lot more peace of mind, and I
Right.
think people will be able to make decisions a lot easier after that. The uncertainty has unfolded.
That's right. Well, you touched on depreciation, so maybe we should start there, Mark. Depreciation when it comes to taxes is basically a non-cash expense that will reduce your taxable income. So in the U.S., you are able to depreciate the building, not the land. Of course, land is not depreciable, so that's a key factor here. Land is immovable, cannot be created or destroyed. Now, there are things, with erosion that could occur, of course. And, if you're on a river and the river floods, you might lose a little bit of your land. But generally speaking, it's not able to be created or destroyed. And so that building you can depreciate over 27 and a half years. And that's in the US. How does it work in Canada, Mark?
Yeah, it's the same thing. And in Canada, it's 27 and a half years that you can depreciate the building itself. So just to build on your point, if let's just say you buy property for $1 million it's cash flowing, we'll just say there's multiple units on it, and let's just say they do an assessment and the land is worth 300,000, the building's worth 700,000. Well, you can't depreciate land. You can depreciate the 700,000, the building. And so over a period of 27 and a half years, you can depreciate the value of that. So that means that you take the total value of the 700,000, and you divide that over 27 and a half, and you're going to have a number. You can actually take that and you can lower you can add that to your expenses pretty much, and lower your taxable income down. So the only thing that you really got to think about is that you are kicking the can down the road. There is recapture there. So when you do sell it, and you sell it for a higher price, the government says, whoa, 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 you depreciated the building, said it was worth less, but it's worth more. There's some recapture there that you got to pay back. So that is something that when you're looking at a building, should I depreciate it or not? I've always leaned towards depreciating the building, because I want to kick the tax can down the road as much as possible, because a dollar in my hand is worth more than, say down the road, yeah, I want to pay it down the road versus today. So a
Yeah.
dollar in my hand is worth more. And so that's how, with depreciation, that's the tax incentive right there with owning real estate. Now, the cool thing with any sort of rental property is that the interest in Canada can be written off on a investment property, but in the United States, and we're going to flip over to your principal residence,
Mm,
you actually can depreciate and write off your interest on your, not only in your investment property, but on your primary residence as well. Whereas in Canada, you can't write off your interest on your mortgage on your primary residence, whereas US you can. So
yeah.
we're going to start and say, okay, that is a major benefit in United States is your primary residence. You can actually use your interest from your primary residence, and you can write that off as an expense. And so in Canada, you can write off your interest on an investment property, and you can depreciate the building over a period of 27 and a half years. So that is a major advantage. Also in Canada as well, how we structure our deals for Canadian investors is that we structure it as return of capital. So if an investor comes in at $100,000 and say they're getting a 5% distribution, so year one they make $5,000. Well, we structure it as return of capital. So at the end of the year, they're not having to pay tax on that
Mm.
by how we structure our deals. And so, but down the road in 5 years when we sell the asset, that's when there's going to be some recapture, and then they're paying tax on as a full capital gain at that point. And so there's a few ways in Canada you can still use tax incentives and structuring to be able to maximize on your taxes and to lower your overall income. But we're going to flip over here now to the US, and we're going to talk about some additional things. So pretty much in the US you can do everything that you can in Canada at a super high level here. And so again, we're not tax consultants, we're not tax experts here. We're going over our own experiences here, just like full disclosure here, John. I think we should have
Yeah,
probably started this
it's true.
with taxes. There's an
Yeah.
asterisk here. Get your own counsel, talk to your accountant. But this has been our experience, owning hundreds and hundreds of real estate units and acquiring hundreds over 100 million in assets under management now. So uh, we're going to flip over now to the United States, John, and we're going to talk a little bit about the additional advantages that Americans get.
That's right. So it's a concept called cost segregation. So basically, there are third-party companies you can hire, and they come in and do a full analysis. And basically, what they're doing is they're breaking the building into real property and personal property. So in the U.S., it's interesting because in a residential single-family home, things that are considered real property or anything that's affixed to the property. So cabinets and countertops, they're quite literally like screwed in, they're glued in, and you can't easily remove them. So those are considered personal or real property. So when you sell your primary residence, you can't take all the cabinets and countertops out and say, well, that's my personal property. But in commercial, things like cabinets, countertops, appliances are considered personal property. And so there is the ability to break those things out. And so there's more rapid depreciation available for that personal property. So it basically is a way to accelerate that depreciation by breaking down those components. As I mentioned, carpets, appliances, roofing, lighting, HVAC systems, et cetera. And so depending on the nature of the product, it can be depreciated at a 5, 7, or 15-year level instead of that 27.5 years. And during the Trump's first administration in 2016, he actually put in something called bonus depreciation, where you could do it very rapidly. That law has sunsetted under Biden, so there is some thought that maybe the Trump administration will bring it back, but it has not occurred yet. But there is still bonus depreciation available. I believe in 2025, it's at 40% of the level, started at
Mm.
100, and each year at sunset, it reduces by an additional 20%. Once again, this is where you really want to get with your accountant. But when you invest with us in the US, we provide that cost segregation study, and it's on your K1. So it's all spelled out. So your accountant will know exactly what to do. But basically, it's a way where those cash distributions you're getting in the US are effectively offset by the depreciation you're doing on the building and that personal property. And so with passive income, you can't take a loss on passive income. So if the depreciation exceeds the cash flow you received, it just kind of is held, and you can then take it in future years, right? So it doesn't, like, I guess in a sense, give you more benefit than you're able to achieve, right? So it's definitely something you want to work with your accountant on. But a strong accountant who has familiarity with this will know exactly what to do, and it's just an incredible way to reduce your taxes, put more cash in your pocket, and still get incredible returns, right? So the cost segregation is critical; it's huge. So once again, our K1s have it all spelled out, but just make sure your accountant is aware of that and you're pointing that out to them when you send over those K1s.
Yeah, 100%. And with the cost segregation, if you were to kind of summarize the idea of it, it's some aspects of the building will say they wear out faster than others. And so
Yeah,
that's pretty much the case there. And so there's you can actually hire this consultant that will come in and say, okay, listen, you can allocate X amount of years to windows, X amount for doors, and you can actually depreciate it quicker, which means that you can use more. You got a bigger number that you can write off your taxes. And basically what that does is any income that you have coming in on a yearly basis, you can take that amount that you depreciate, and you can actually say, okay, I'm lowering my income by X amount, which means that you're going to be paying less taxes.
that's right.
And so the bonus depreciation, cost segregation, this is how, when you hear, oh, this guy didn't pay any taxes, and you say this, this real estate investor didn't pay any taxes. Well, it's because they depreciate their income down to zero. And so they're not they're not making anything on paper, because they are actually making it. But what they're saying is, okay, I'm lowering down my taxable income down to zero, and that's a huge benefit. It's like we're staying within the rules that the government has created. It's just you're doing it in a very efficient, effective way.
That's right. I have an investment, Mark, and it's 5 new apartment buildings. It was actually in an opportunity zone, which we'll briefly talk about at some point. Another program that will sunset in a year or so, but Trump may bring back. So we're watching and seeing that. But it was really cool because the buildings have not yet started monthly distributions. They will this year, but there was a refinance on one of the buildings, and I got a $25,000 distribution, but there was a loss of 27,000 due to the cost segregation studies that were completed. So I mean, just right there, it's like I got the income in, but paid no taxes on it, and so my accountant took care of all the details. But it's fantastic, and I mean, it just goes back to why 90% of millionaires got that way investing in real estate. I'm a firm believer that, as a citizen, it should be, kind of considered an honor to pay taxes, right? The more successful you are, the more taxes you pay. But I'm also a firm believer you should pay no more in taxes than you ought to, and you should, according to those rules that have been set up and
Yeah.
established, right? And so, I would tell you, if you're somebody who does your taxes on your own, or if you, maybe just have a part-time type account, and if you start investing in these types of deals, it's time to amp it up a little bit and find somebody with a lot of experience in this stuff, because they'll be able to find things that, maybe we're not even talking about or mentioning here today. So, pay your taxes, but don't pay any more than you have to. That's my philosophy.
And that's make wise choices. That's right in alignment with that wisdom value that we have there, John. So
That's it.
very
That's it.
smart.
Yeah.
So the my favorite though is this 1031 exchange. They call a like kind exchange. So the beauty when you're investing in real estate is when you sell it, you're paying a capital gain. So capital gains tax is the best kind of tax that you want to pay. So versus regular income tax. And so pretty much it's you sell the building and or the asset, and you made, say, we'll just say $1 million, for example. Well, half of that is going to be taxed at your regular income level, and so it's a fairly decent tax rate to begin with. But when you do a 1031 exchange, the government says, okay, you have X amount of window, and we're going to be talking about the timelines here, to be able to buy another asset that is like kind. So it's if you're selling an apartment building, and then you roll it over into, say, you take that $1 million and you roll that over into another like kind or another apartment building, maybe it's a bigger one. That's why with Rich Dad Poor Dad and cash flow, you can see that he constantly wants to sell the houses and go and buy the hotels, right, or in the larger assets. And so, like Monopoly, right,
Yeah,
that's the
that's right.
idea. So you can roll over the gains into the next deal, and you pay zero tax if you do it within X amount of time. We're going to be talking about the dates here as well. So this is how you're able to grow your wealth way faster, because you're keeping more of it and you're rolling it into the next deal. Now eventually, when you sell that, we'll say that 1,000 unit community, because you keep rolling over, you get into the bigger properties, you're going to pay tax eventually on that capital gains, but you're growing tax-free money time over time. And so the 1031 exchange is very effective. And so this is not permitted in Canada. Although I did go to the best accountants that I could find in Canada, I just there's no way that as a Canadian you can get access to this, and so, but American residents do, and
Yeah.
so this is a very effective way to be able to grow your wealth very quickly. And so, John, maybe you want to talk a little bit about the timelines with this.
100%. So all of our deals, so if you're a US investor investing on our deals, we will structure them so they're available for a 1031 exchange. I mentioned that because the operator, in this context, Faris Capital Partners, has to follow certain steps for it to work for our investors, and we do that. So if you're thinking of investing with a U.S. operator and you're a U.S. citizen, just make sure you're asking that question: will you be, building your exit to accommodate a 1031 exchange? So with a 1031 exchange, you actually have to work through a third party intermediary. They're fairly easy to find. You just do a little research, and we'll obviously offer resources to our investors there. But the timelines are as follows. So you have 45 days from the closing to identify the replacement property that you plan to invest in. And you typically identify at minimum 3 properties, because ultimately you want to have choice, because 45 days might seem like a lot of time, but you have a closing and now all of a sudden you got to go and do due diligence and review a couple of options. So you want to put more than just one option in there, and they typically recommend at minimum 3. So you identify those properties, and then you have 180 days from the date of the exit, that original closing. So 45 from the date of exit to identify, and 180 days from the date of exit to deploy that capital into another investment. And if you work with that third party intermediary and follow those timelines, then you're basically kicking that can down the road on that tax there. You're paying no capital gains and rolling it in. And so, it's a way that potentially over decades you can just continue to build wealth without paying any taxes until you finally exit, ultimately at some point in the future. So if you're somebody who invests in real estate, you ought to be taking advantage of these 1031 exchanges. Our goal on a typical investment is to double your equity in a 5-year period. So just think about the compound nature of that. If you took 100,000 in one of our deals and we gave you back 200, and then you roll that into another deal, right? Just 8. I mean, and rapidly you're growing your wealth while also getting the benefit of everything we've talked about before: the depreciation, the cost segregation, and then the passive income those deals generate. And what's interesting with like kind is, it doesn't necessarily have to be an apartment to an apartment. Say, for example, you own a single family rental property for 10 years, you sell it and have a nice profit. You could roll that into an apartment. And then maybe you decide you want to invest in a hotel building. You can roll it into a hotel. So you have some flexibility on the types of investment. You're not locked into, say, apartment buildings just because you started with apartments. Although we love apartments and think they're the best asset class to invest in, you have some flexibility there in terms of the style of investment that you go into. So it is a incredible benefit for U.S. investors, one that all investors should be taking advantage of in the U.S.
Yeah, 100%. And so the 1031 generally is more for direct property owners, but for the syndication model that we run, that it can still definitely be structured. It would need to be structured as a TIC structure, tenants in common structure there as well. But what I'd recommend, and John, you and I, we've talked about this, is that if you are interested in doing this for in the future when we go to sell, you just let us know, and then we would help navigate through that. And so you might actually have some 1031 exchange funds that you're looking to bring over from another deal and roll that into ours. So just give us a heads up on that, and then we could structure it to be effective and to be able to make that work with your goals moving forward there as well.
That's
The
right.
sooner we know about it, the better. So if you are thinking about doing a 1031 exchange and you like what you're hearing from us, reach out, book a one-on-one. And then that way there, when we get that next deal coming up and we're structuring the legal docs for that, we can, we can get ahead of it
That's right.
on that end. Yeah.
And this, in a sense, we sort of touched on this when we talked about cost segregation, but it's the passive losses component. So any passive loss can offset a passive gain. And so if you have a passive loss on, a deal, and maybe that's through some of the depreciation and expenses we already covered, and then you have another deal that you're in as passive income, and it produces more income than loss, you can actually offset some of the taxes on that other deal from the loss that occurred on the first one I mentioned there. So just that ability to offset some of those that passive income coming in by taking a loss on another deal. So that's another great advantage offered to U.S. investors. So at the end of the day, Faris Capital Partners is looking for ways to just minimize your taxes across any investment we do. So we provide the T5013s on time with all the pertinent details. In the US, the K1 is a similar document, but just on the US side of the border. No delays, on time, with all of the depreciation spelled out, all the cost segregation details for those US investors. Those studies we do the second we close. So as soon as we close, we work with Harbor Tax Group. They come out and run that analysis. So no delays there. And we work with great accounting firms like Zeifman's that make sure we're setting up our deals for success on both sides of the border. So it's not something we just take willy nilly. Like, we put a lot of thought into the structure of the deal. So on both sides of the border, our investors are well looked after and are able to minimize their taxes most effectively.
Yeah, and when you first hear all this, 1031 exchange and cost segregation and bonus depreciation, it seems like it can be overwhelming. And the reality is, when you have a really good accountant working beside you, they really will help you navigate all this. And we're here as well. If there's any questions, feel free to reach out. But the really cool thing just to think about is, at a very high level, if you're getting 20% annual returns and you're getting major tax benefits on top of that, so you can keep more money in your pocket, it's not how much money you make, it's how much money you keep. And so that's where real estate really takes it to a whole other level there, where you can leverage it. You can put 20% down and leverage something 5 times greater. You can get high returns through the value add approach, which is our approach that we do. And then you got tax incentives there as well that keeps more money in your pocket. And John, I know there's like more and more advantages there, but ultimately the tax benefits that you get at the end of the day just puts real estate at a whole other level, where I'm personally, I believe it's the best thing in the world to be able to get rich. And the numbers back that up, that 90% of millionaires used it. And so the tax strategies that we shared with you is one of the reasons why it's gone to the next level. Well, guys, if you're interested in investing in real estate and can't find any good deals out there, go to fulloutinvesting.com, where you'll see our 10-step full out investing process and a sample deal as well. Plus, you can book a one-on-one call with John and myself to learn more. Thanks for listening. If you guys enjoyed the show, please subscribe and share with other high net worth investors that you think you'll benefit from it. We love and believe in you guys. Keep dreaming and investing big.